Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Leland Clements, co-founder and CEO of BondBloxx. BondBloxx is the first ETF issuer to focus solely on fixed income ETFs, and those are really precise ETFs. And the firm is just about 2 years old, a little more than 2 years old, and they already have 23 ETFs with over 2.5 billion in assets under management. So that's amazing, an amazing ETF success story. And their product suite includes US Treasury bond ETFs, industry and credit rating specific high bond ETFs, high yield bond ETFs, emerging market bond ETFs, and they recently launched some investment grade corporate bond ETFs as well. Leland, welcome. Great to have you on the show.
Thanks, Neena. Thanks for having me.
So, as I mentioned, BondBloxx is an amazing ETF success story. And since you're joining us for the first time on this show, please tell us a little bit about yourself and about BondBloxx.
Thanks for having me. Excited about the conversation. So I've been in and around ETFs and fixed income for the last 20 some odd years. I spent the first decade plus working and building the iShares business, both in the US and in Europe. Then I was fortunate enough to have an opportunity to work on and build fixed income business, TradeWeb's business in Europe for a couple of years. And then, as you said, in 2021, founded BondBloxx with a group of partners who have really led innovation in ETFs and fixed income markets for the last 20 years. And we just felt that the fixed income landscape had been underdeveloped in the ETF space and presented an opportunity for us to build products that give investors more choice.
Great. So I looked at your website and the word precision is mentioned a lot. So tell us, what do you mean by precision in fixed income exposure and why that matters for investors?
So precision always matters when making investments of any kind, whether you're investing in large cap equities or small cap equities or in high yield bonds or US treasuries, right? We want investors to have the choice to be very intentional in choosing a product that maps to whatever investment thesis they have. The ETF landscape has really been lacking a great deal of choice for the last 20 years. Most of the innovation of late has focused on equity factors, ESG, thematic equity exposures, all of which are great and fine, but less than 20% of all ETFs provide exposure to the bond market, despite the bond market actually being larger than the equity market. And we just feel and have felt that as interest rates return to more historically normal levels, you have and will continue to see performance differentiation across different parts of the fixed income market, whether that's in maturities or credit quality. That performance is very real. And investors have now the ability and candidly the right with BondBloxx ETFs to be more intentional in how they manage their fixed income exposures in the same way they do in the equity side of their portfolio.
So, as you mentioned, bond ETFs currently account for just about 20% of the ETF market. But last year, they gathered about 35% of total ETF inflows. That was just amazing. And of course, a lot of money went into shorter duration bond ETFs, those money market like bond ETFs. That was mainly because of very attractive yields at the shorter end of the yield curve and very low sensitivity also. So very low duration risk. But we also saw a lot of bottom fishing in longer duration bond ETFs. So much money went into TLT. That was a much talked about story because investors were maybe just trying to time the market. They were trying to buy the dip. So tell us what was happening last year. Why do you think investors poured so much money into fixed income ETFs in 2023? And your firm also gathered a lot of that cash.
Yeah, I think it's the right question that I think so many advisors are spending time on right now, which is, with the return of higher interest rates, bonds deserve a closer look and maybe a higher allocation in the portfolio. Bond ETFs offer lower volatility versus equities. They pay distributions on a monthly basis, which inherently de-risks the overall investment thesis. And with current yields, investors, I think, have had to increase their expectations of what the equity side of the portfolio has to earn to maintain what have been, for the last 15 years, a fairly outsized portfolio allocation relative to bonds. And I think in many cases, that reconsideration of equity risk premium compared to, the benefits of income earned through bond ETFs or bond exposures has led to selling down the equity side of their portfolio and buying more into the bond side of the portfolio. So I think that the investment case, and then I think why you see that happening in ETFs is, over the last 20 years, advisors and investors of all types have increasingly shown that they prefer the transparency and exchange traded, oftentimes lower cost nature of the ETF product. So when you see the portfolio reallocation happening, you're seeing it most evident in ETFs, which led to, as you said, very 200 billion plus of inflows into ETF product. And in fact, over the last sort of 3 to 5 years, you've seen growth rates in the fixed income ETF category, well north of 20% on an average.
Yeah, it's been amazing growth. And looking at slightly longer term growth outlook, I saw on your website that the industry is projected to grow over 40% by 2030. And you cited some Bloomberg stats. And I also noticed that BlackRock projects that the global bond ETF assets under management will grow to about 5 trillion by 2030. So what is driving this growth in fixed income ETF market over the longer term?
You're exactly right, Nina. The expectations, and I think, forecasts for where we get to in 23, most folks were at 5 trillion, maybe a year, 18 months ago. And those expectations have now been ratcheted up to 6 trillion by 2030. And so I think that there's a very real expectation that with this shift in portfolio allocations will come a dramatic increase in usage of fixed income ETFs. I think what's driving the growth is you got a return of higher, more normalized interest rates after 15 years of historically low rates, historically low volatility on the back of very extraordinarily accommodative policy from the Fed. In that same time frame, ETFs have become almost the default investment vehicle for advisors, and in many cases, certain types of institutional investors. Those investors are choosing ETF for the intraday liquidity, the price transparency, the tax efficiency, and then also the diversification and just ease of use of ETFs. The third driver, we believe, that will sort of lead to this, $5-6 trillion of fixed income ETF assets by 2030 is a very real modernization of fixed income markets that is also occurring. That's bringing more transparency of pricing, a growth in electronic trading from platforms like Tradeweb and Bloomberg and Market Access, and also just better liquidity provision, making it easier for ETFs to exist, make it easier for investors to benefit from those attributes of trading and bond exposures on an exchange. So you put those things together, and I think you have a very real and credible case for a continued, 20+% growth rate that will take ETFs over the next, 6 years to $5-6 trillion in assets under management.
So let's take a step back and talk a little bit about advantages and disadvantages, if any, of investing in bond funds, bond ETFs versus investing in bonds, because this is a question we get from our listeners sometimes. Which one is right for you? How should they decide and understand before choosing between the two? We know that ETFs offer lower cost, convenience, diversification. Are there other advantages or any disadvantages?
The first and foremost benefit, I think, to bond ETFs over buying individual bonds is just efficiency. If you consider, sort of, for example, we have BondBloxx has a high yield CCC ETF, which owns CCC rated corporate bonds. In that ETF, the fund owns 230 individual bonds. Now, CCCs were the top performing segment of the fixed income market, or one of the top performing segments of the fixed income market in 2023, because corporate fundamentals have remained strong. High yield is shorter duration than other corporate bonds, and therefore less sensitive to Fed interest rate hikes. And the ETF has a 13% yield. But it'd be very difficult for any investor to acquire and maintain a diversified portfolio of 230 bonds, and thus not incur any significant transaction costs or have sort of concentration risk from owning one or two CCC bonds. So the efficiency is similar to what investors have benefited from equity ETFs that track things like emerging markets or single countries, where there's just an efficiency and candidly an ease of access that the ETF provides. I think that's very much a driver of benefits for investors in using fixed income ETFs. You just get diversification, price transparency, their low cost and tax efficiency. The contra to that would be most bond ETFs do not mature in the same way an individual bond does. So, if in 3 years you are going to need all of the principal back, and you're going to use that principal plus interest to do something else, not continue to want the same bond market exposure or exposure to bonds, then buying an individual name might make sense. But in doing so, you do take, again, just as with any other investment, some concentration risk, right? You're buying a bond. And so we feel like the benefits of diversification, transparency, and candidly, that management of a diversified portfolio outweigh the sort of need for having something mature at a very specific time.
All great points and quite helpful. Now, let's talk about BondBloxx's fixed income market outlook for 2024. So the Federal Reserve has signaled 3 interest rate cuts this year, but investors still expect much more aggressive rate cuts, and the Fed Fund futures now suggest 4 to 5 rate cuts this year, which is totaling 100 to 125 basis points. And that has come down significantly from expectations of about 6 cuts earlier, which was totaling 150 basis points. And now there's just about 18% chance of a cut in March, which is down for more than 50% before last week's Fed meeting. So tell us about your outlook. How many interest rate cuts do you expect this year?
So prior to the Fed's announcement recently, I think we feel like many investors were sort of forecasting with their hopes rather than forecasting, thinking about what the economy needs. We just candidly, when you look at corporate fundamentals, when you look at the strength of the economy and the numbers that continue to be posted, there's not a lot of rationale for aggressive cuts in the immediately coming months. So we feel like the Fed will probably still cut, but we think that's more the back half of the year in 2024. Last year, we were proponents of buying high yield, as I said, CCCs in particular, because of the corporate borrower fundamentals. They're just stronger than many investors, I think, might think. We continue to like high yield for the income generation potential. In particular, we like single B and triple Cs, and we have 2 ETFs that track those exposures. In investment grade, as you mentioned, Nina, we launched 3 triple B ETFs that enable investors to take advantage of what's actually been a pretty persistent outperformance of triple Bs in the investment grade sector over time. We like those exposures because we believe corporate fundamentals are strong when you look at interest coverage ratios and just the balance sheet relative to the interest expenses. We think the economy and corporate issuers are in good shape relative to maybe what investors have been thinking in over the last year. Because we think the Fed is going to cut, but we are not thinking it's in the next month or two, but rather in the back half of the year. We do like lengthening out from sort of the shortest cash-like treasury exposures at sort of the 6-month, 1 year to the belly of the curve, somewhere in that 7-year time frame. We think is a good place to be. That positions for some of the cuts, but yeah, that's sort of where we are in how we think about what the Fed's activities might be and how investors could benefit or position in that context.
So let's talk a little bit about your ETFs that offer exposure to those areas of the bond market. And I noticed that your 6-month target duration US Treasury bond ETF, the ticker symbol is XHLF, that took in more than $950 million last year, and it is now your most popular product. And you are recommending that investors should take some duration risk now, increase their duration in the bond portfolio. And you also talked about credit opportunities. So talk to us about some of the ETFs from your suite that investors should look at now.
So again, we just launched these triple B investment grade corporate ETFs last week. We launched 3 that give investors the opportunity to both choose a maturity bucket. So they're 1 to 5 year short, 5 to 10 year intermediate, and 10 plus long maturity buckets of just the triple B exposure. So there are other ETFs that have been in the market for a while that offer exposure to broad investment grade in those same maturity buckets. But when you look at what has driven the yield and therefore the total return in those exposures, it pretty persistently is triple B. Triple B are the largest component of investment grade, and they're just they have very limited relative to the broader investment grade space. There's really no incremental default risk, but there is a persistent outperformance from a total return basis because you get about 50 basis points of incremental yield. So we really like those, again, based on corporate fundamentals as you look into 2024. Just balance sheets are strong. As I said, we do continue to like high yield. We think the total income generation opportunity is just fantastic and in high yield. Double B issuers, which has a really high concentration to energy companies, have really strong balance sheets in our X double B product. If you look through to the issuer level, and then we think the yield, which is around 13% in XCCC, which is our triple C high yield corporate ETF, 13% yield offers a pretty good yield cushion, even if there was an increase in defaults. But as I said, we continue to think corporate balance sheets look pretty strong, even in the triple C space. So that's sort of on the corporate side. And then, as I said, Nina, you're right. We do have some of our largest funds are on the shorter duration segment of the U.S. Treasury space. I think in part because we charge 3 basis points for 6-month and 1 year target duration Treasury exposure. There are a lot of other ETFs out in the marketplace that may charge 15 basis points for the same exposure, and we just feel like that is dated pricing, and therefore we've tried to improve upon that. But we have Treasury exposures that also offer targeted duration to 2 years, 3 years, 5 years, 7 years, 10 years. And we've seen in recent weeks investors adding duration. So buying, the 2 year, buying the 5 year, buying the 7 year. just to position for those Fed cuts in the back half of the year.
Excellent stuff, Leland. We'll have to leave it there, but thank you so much for joining us today, and congratulations on all the success that BondBloxx has had.
Yeah, thank you so much, and thanks for having me.
That was Leland Clemens of BondBloxx. Now, let's talk a little bit about some of the ETFs that we discussed and recap the tickers. So their most popular product is the 6 months Treasury bond ETF. This has over 1 billion in assets. The ticker symbol is XHLF, X-half, and charges just 3 basis points, a very attractive expense ratio. And this currently has a 30-day SEC yield of close to 5%. So very attractive yield and low expense ratio. If you want to take some duration risk now and extend the duration a little bit, then maybe take a look at the 1 year or 2 year target duration bond ETFs. And ticker symbols are easy to remember, X1 for the 1 year. And that also charges just 3 basis points. And the one X2 is for 2 year target duration. That charges 3 basis points currently. Now, if you want to take some credit risk, he talked about the outperformance of high yield credit, then maybe let's talk a little bit about those ETFs. So in the high yield space, if you want to focus on the highest quality, high yield companies, high yield bond ETF, these are the companies which have the most balance sheet strength and lowest default risk. Then the ETF that you may want to look at is XBB. And this has an expense ratio of 20 basis points and a 30-day SEC yield of 6.3%. And if you believe that the risk of recession this year is just overblown and economy is going to do fine, then maybe take a look at CCC bond ETF, which he mentioned was the best performing area of the bond market last year. So if you want to capture those attractive income generation potential with those kind of bonds, then take a look at XCCC, XCCC. This has an expense ratio of 40 basis points and a 30-day SEC yield of 12.6% currently. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.